Brian. Welcome back to the podcast.
Thanks for having me back, Kevin. Good to see you.
As always, let's start with an update on the markets. Q4, if you can give us the notable developments for the quarter, as well as just if you have thoughts on kind of how the year went as well.
Sure. So, we spoke about 3 months ago, and for me personally, it kind of feels like the world has turned upside down, or maybe even worse since then. And I got to tell you, there are mornings I don't feel like getting out of bed, and I don't even have any social media, Kevin. So I don't know what people with social media, I don't know how they do it. But my focus is investing in credit markets, which is why you're having me back. I'm not an influencer, thank goodness. So I would say while the world kind of feels upside down, when we look at credit markets and credit spreads specifically, kind of looks like everything is sunshine and rainbows. And so we always talk about spreads. And just to remind people, spreads are the incremental yield you earn for lending to a company instead of a sovereign. So spreads, the way they finished last year, the way they've started this year, they're tighter. They're tighter in every major currency, and they're tighter across investment grade bonds, so higher quality bonds, and they're tighter in high yield markets, so lower quality bonds. So, and again, just to remind people, as risk premiums or spreads compress, everything else being equal, bond prices rise. So that's good for people who are invested in credit. Now, historically, for lending to higher quality companies, you earned about 1.5% extra. Today, that's less than 1%. And for lower quality companies, high yield, today you earn about an incremental 3%, and the historical average is about 5.5%. So overall compensation for lending, those risk premiums are pretty skinny. And anticipating your next question, Kevin, as I like to do. So you say, how can this be when things are so chaotic or seem so chaotic in the everyday world and credit markets seem so calm? And again, want to remind people that about 2/3 of the global credit market is denominated in US dollars, and about half of the issuers in the credit market are domiciled in the US. So all the things that are causing many of us angst, higher tariffs, and other policies coming out of the new administration, coupled with lower taxes, reduced regulation, all of those things could and should be good for companies that are based in the U.S. and doing most of their business in the U.S. So again, if you're inside the walls of the fort, it's all good. Anything goes, full steam ahead. And so the challenge for that as a lender is we believe if companies are earning higher revenues, higher net income, generating more cash flow, if and when those things transpires, those are likely to accrue to the benefit of shareholders and not to lenders. So mergers and acquisitions, share buybacks, special dividends. So I said it last time, I think it's not going to be cool to deleverage in Donald Trump's America. So as a lender, we need to be aware. So what should we be doing? And this is a similar theme to how we finished out last year. What should we not be doing? Investors should not be reaching for yield, in our opinion. So either by going down the credit quality spectrum, by buying high yield, or extending out the yield curve into longer dated credit. We don't think investors are being compensated for taking those risks. This is a market where investors should focus on protected capital. So the theme from our last conversation has carried over into this conversation.
So with spreads being, as tight as you mentioned, is it safe to assume then that defaults are relatively low right now? You mentioned that the markets are pretty calm. So is that a safe assumption, or are there weaker pockets of the market that you guys are looking at?
Yes, are the short answers. The slightly longer answer is just to remind people what default risk is. That's the chance that a borrower fails to make interest or principal payments. And credit spreads are the compensation an investor receives for accepting default risk when lending to a company. And the lower the credit quality, the higher the default risk. So the more compensation you should get. So right now, our good friends at JP Morgan have pegged the long-term average default rate at about 3% for lower quality bonds. So about 3% of the market should default every year. Today, as we look back at 2024, we're right on that 3% default rate. And of those companies that default, the recovery rate for lenders is about 35%. So you get about 35 cents on the dollar lent for every company that defaults. So I would say we're seeing some cracks in certain segments of the lending markets, and you've probably seen articles about credit card delinquencies going up, mortgage delinquencies seem to be creeping higher. That hasn't really translated into higher bond defaults yet. I would also point out that, although the long-term average is about 3%, we have had periods where default rates spike into double digits. So if you think 2009, global financial crisis, 2020, COVID, default rates spike significantly. And at the same time that default rates spike, we tend to see lower recovery rates in those periods too. So, markets can be kind of expensive and complacent for long periods, and then they get punctuated with periods that can be pretty awful for lenders. I would say one of the reasons we believe default rates haven't gone up is we are seeing what I would call intensified competition within credit markets targeting lower quality issuers. So there's the high yield bond market. There's the private credit markets, which I know you've written extensively on. There's kind of a resurgence in leveraged loan markets fueled by CLOs. And then the traditional banks are trying to get muscle back into all that business that they've kind of given away. You saw JP Morgan just the other day saying, we're going to commit $50 billion to direct lending. And they're a traditional bank. That is really what their business is. And they're kind of recommitting capital to it. So there's a lot of capital chasing relatively few transactions. And companies that in a different era, what's the outcome of that? Companies that in a different time might have defaulted and been forced to either restructure or liquidate now have more options. So there's more lenders. And some of those lenders, some of those markets are willing to tolerate higher leverage, weaker business models, what we call PIK, so pay-in-kind structures, all of these things which allow weaker borrowers to continue operating when in different times, different eras, they might have actually been forced to default. So the last point I'd make, it's surprising to me we haven't seen spreads widen in other markets, other non-US credit markets. So Europe, Asia, Australia, those markets that are outside the walls of the fort, which could seriously be, very much negatively impacted by what's going on within the U.S. So we're watching for signs of weakness in those markets, but we haven't seen any yet.
Picking up on that comment around the banks making a push back on the lending side. So they had kind of pulled back post, financial crisis. There was capital rules that were put in place that made it more costly for them to lend. So now that they're moving back in, is that on the balance sheet itself? Or I know you mentioned JP Morgan just as an example, but does it tend to be on the balance sheet, or are these private credit funds that they're raising? Or if you could just explain a little bit more about that.
I think it's a combination of both. So you've actually seen banks become investors in private credit funds. And then you've seen banks also competing against those very same private credit funds to do loans that they would keep on their own balance sheet. So I think it's an effort to, as a bank, if we're a bank using JP Morgan as an example, and I don't want to speak for their strategy, but it seems like wherever those companies are borrowing, whether it's traditional bank, private credit, leverage loan, they want to be in that market and they want to be taking exposure. They want to be acting as underwriter, distributor, trader. They want a piece of the action regardless of where that takes place. And so you've seen a number of banks make announcements where they're going after a market that kind of 5 years ago they had been willing to give up.
Now, the global credit strategy is a very broad mandate. The focus is investment grade credit, so investment grade bonds, and high yield. But the investable universe includes a lot of other categories as well: securitizations, potentially private debt. You mentioned leveraged loans, and actually you also mentioned CLOs, so collateralized loan obligations. Focusing on CLOs specifically, they aren't really an area I think we've talked much, if at all, on the podcast to date. But can you briefly walk us through, what CLOs are? Are they on the team's radar? Is it things you're looking at? And if you guys have a current view on the market and any interesting positioning, if you do have any.
Yeah, well, I think there were like 5 or 6 questions in there, Kevin. So let me see what I could do. So yeah, and see if you can say collateralized loan obligation 3 times fast, because I know I can't. So, I mean, trying to simplify it, CLOs they're a structured vehicle. So they raise money, a little bit of equity, a lot of it debt financed, and they take that money that they've raised and they invest it in a portfolio of loans. And they could be kind of traditional bank syndicated loans, where there's a little more transparency, a little broader syndication, or more traditional private credit, which are kind of narrowly distributed loans with less transparency. And these are typically put together with a 10-year life cycle. There's a ramp-up period, a reinvestment period, et cetera, et cetera. Effectively, though, CLOs are the driving force behind the leveraged loan market. So the leveraged loan market is about $1.2 trillion in value, US dollars. About 65 or 70% of that market is owned by CLOs. So it's just another way of creating demand. It's leverage on top of leverage. And so what we've seen in 2024, again, we talk about complacency. We talk about getting further and further away from the last crisis. Markets kind of find innovative ways to reach for yield, which is something we don't think people should do. Again, our friends at JP Morgan have some statistics. CLO issuance in 2024 exceeded $500 billion, and that's versus about a little over $160 billion in 2023, so a huge increase. And new CLOs, so not just existing CLOs, new CLOs put together were almost $250 billion, and that's $100 billion more than in 2023. So, there's a lot of demand. We talk about demand for lower quality product coming from a number of places. A lot of that demand has come from kind of the reemergence, the rebirth of the CLO market in 2024. And the leveraged loan market really exists and depends on the leverage embedded in CLOs. And I think the enthusiasm for CLO debt and the knock-on enthusiasm for leveraged loan demand is unmistakable, right? Based on the numbers I just gave to you. And it's just another example of that leverage on leverage in an opaque market, and an example where investors are reaching for yield, relatively marginal pickups in yield. And we think it's a market that we're watching very closely, because if there's a dislocation, it will absolutely hit the leveraged loan market as it hits the high yield market. If you look back to 2008, I think the high yield index was down about 26, 27%. The leveraged loan index, which are meant to be very, top end of the capital structure, the most senior portion of the capital structure for lower quality companies, the leveraged loan market was down about 30%. So it behaves in this similar fashion to high yield. So it's a market that's of interest, and it will be something that we likely will include in some small portion in the global credit strategy at some point. But today, it's just another market we're monitoring, Kevin.
And then maybe a follow-up to that, and also, I guess, tying together some of the points you made on some of the previous questions. So spreads are tight. You mentioned these areas of risk. Why not just a little bit of high yield, or a little bit of, pick your other segment of global credit? Certainly, points well taken in terms of the spreads being tight and the risks that are there. But aren't there some opportunities in some of these markets? Like why the posture, I guess, of no allocations to some of these segments at this point in time? If you could just sort of walk through your thinking there.
It's tempting, Kevin. It's tempting, and I know that's why you asked the question. And maybe you're trying to goad me into saying, "Oh yeah, okay, we'll put a little in." And Howard Marks, one of the founders of Oaktree, who writes a wonderful letter, I think in the fall pointed out that the all-in yield on high yield was about 7%. And that's kind of where we are today, 7%. And I think his kind of quote was, "Who doesn't love a 7% return?" And so when you think about that, you're like, okay, what could it hurt? I'm not going to have 100% high yield, because if something goes wrong, I could really be in trouble. But if I just have a little bit, that adds a little bit to the portfolio, a little more yield. And that should be okay. And so, what could it hurt? And I'll give you some numbers. So in 2008, a portfolio of investment grade bonds, so not high yield bonds, produced a negative return of a little over 5%. So negative 5% in higher quality bonds. If you had a portfolio of 75% investment grade and 25% high yield, that return all of a sudden becomes negative 11% plus. That's only 25% in the portfolio. So another example, another way to think about it, if you started 2008, investor who's thinking, okay, maybe the market looks a little frothy, a little expensive. I want to preserve capital. That's one of the reasons I have fixed income. If they had short-dated investment-grade corporates in 2008, and that's all they had, it would have been a slightly positive return, less than 1%, but positive. Add 25% high yield to that portfolio where you're like, I'm generally conservative, but I want a little bit of a boost. All of a sudden, that return is negative 7% plus. So, was that potential benefit of owning 25% of high yield at the start of 2008 worth it? I would say no, because the incremental yield benefit in 2008 was about 1%. You're adding 25% high yield in the hopes that you're going to get an extra 1%. Today, when you do that same calculation, that potential incremental yield benefit of 25% high yield is about 60 basis points, 0.6 of 1%. We don't believe investors are compensated for the risks inherent in high yield. And we didn't believe it in 2008. We certainly don't believe it today. So I appreciate the temptation is there. Just a little bit more, how risky can it be? And we're in that type of market where people seem to be willing to make those concessions, But if the concession means you don't sleep as well at night, and if something goes wrong, your slightly positive return becomes decidedly negative, it's not worth it.
So definitely discipline on valuation, I guess, is kind of the key summary there. And then I suppose on the other end too, by sort of protecting capital now, you're saving dry powder for if you have that dislocation, you've got some pretty attractive opportunities that you've got capital you can put to work.
That's the punchline, which I failed to give. So thank you for giving it, because that's right. The opportunity cost of being 25% already in high yield means you couldn't move into high yield at exactly the right time. So thank you for pointing. Thank you for doing my job, Kevin.
No problem. Okay, so we've covered high yield a lot. And we've covered a few things that we don't own in the portfolio. I want to shift a little bit and talk much more about what we do own in the portfolio. So if you could walk us through your current portfolio positioning, your current views on the market, and how what the characteristics of the portfolio are today.
Just to remind people, the portfolio characteristics are the sum total of a series of individual credit determinations. And if we're doing our job right, executing our process right, those individual determinations should insulate the portfolio from risk in expensive markets, which is what we believe we're in now, and then activate into attractive situation in dislocating markets. So again, we like to say we don't want to diversify away return potential, but we don't want to bet the farm either. So we typically would think we'd have 20 to 30 names in the portfolio, 10% maximum weight. Today we have 23 unique issuers in the portfolio. We're uncertain where longer-term yields are going to go. And as a consequence, we're buying shorter-dated bonds, so the duration of the portfolio is just a little longer than 1 year. And we're buying, for reasons we just talked about, we're staying away from lower-quality credits, and we've got a very, very high-quality strategy with no high yield. So 81% of the portfolio has a credit rating of single A or better. And in terms of geographic exposure, for those who are interested, about 3/4 of the portfolio are companies that are domiciled in the U.S., about 14% Canadian, and about 8% European. And then the last point I would make, just to remind people, because it's really important, when we buy non-Canadian securities, and most of the portfolio is invested in U.S. dollar denominated securities, we're hedging back that currency risk using 3-month currency forward. So we're isolating credit risk and we're not taking currency risk.
I do have one more topic that I'd like to cover, but before we do that, is there any other items of interest, things you'd like to cover before we move to that final topic?
There are. So thank you for asking. There's a few things that are kind of sticking in our mind as we look at markets these days. And the first is one that's a little bit unique, I would say. The first is the U.S. government. We're thinking a lot about the U.S. government and less about kind of the daily noise that's coming out of the Oval Office, but more about, I mentioned 2/3 of the credit markets are denominated in U.S. dollars, and the U.S. Treasury yield curve is the benchmark off which corporations are borrowing money. And so with all the unpredictable policy announcements, the uncertainty over whether the deficit is going to grow by X or Y, regardless of whether Mr. Musk is successful, what's the impact of further tax cuts on the deficit? The credit quality, forget the policy quality, the credit quality of the U.S. government is a growing topic of conversation. And to me, it seems that a downgrade by Moody's, who are the last agency to have them rated AAA, is a question of when, not if. And so right now we've got U.S. 10-year yields at about 4.3%. Those look really attractive because a few years ago they were 1%. But if the credit quality of the U.S. government is now being called into question, which I think it is and should be, we are in a position where we're now kind of forced to evaluate not just the credit quality of the issuers we're looking at. We have to think about the credit quality of the benchmark that we're pricing those issuers off of. And that's something, quite frankly, you kind of have to go back to Canada in the 1990s when deficits were kind of out of control here, in my mind, to kind of come up with a similar situation. So credit quality of the U.S. government, kind of top of mind. I came across something. We talk a lot about private credit, you and I, Kevin, and I know you've written on it. It's one of my favorite topics. There was a great article in Bloomberg about a week ago, and the title of the article was "Wall Street's New Money is Shaking Up the Ranks of the Super Wealthy." And it highlighted how many billionaires have been minted, and according to them, it was 18 by the private credit industry. So, which raised a question for me. And the question is, and you don't have to answer on this call, you can just take it away and think about it. The question is it better to be a private credit manager than a private credit investor? Because I haven't seen many articles written about how many private credit investors have become billionaires. So that, let's just say that's a rhetorical question, but it's interesting as we think about how much money has gone into private credit. It does raise a question about what are the fee structures versus the benefits of that, et cetera, et cetera. So I thought that was interesting. And then finally, just a thought on the companies that we are thinking about including in the strategy or have included in the strategy. High quality companies we think should be setting policy for more than just kind of a 1 or 2 year horizon. And management teams, if they're really doing their job, should be able to plan and should expect to outlast any one administration or regulatory regime. So we're being vigilant, and I'm sure our colleagues on the equity side are as well, for companies that are kind of dramatically changing their business models or financial policies based on what may prove to be kind of short-term extreme changes in government policy. So a number of things we're thinking about and monitoring, and in the case of private credit, kind of having a chuckle about.
3 interesting thoughts, no doubt. But in the interest of time, I'm going to move to the last topic. Maybe we could circle back on some of those thoughts on a future podcast. But as of the end of January, the global credit strategy hit its 1-year anniversary. So congrats to you and the team. Just want your thoughts on how the year went and plans for the future for the strategy.
Yes, well, thanks for noting that. I've got to say we are ecstatic with the progress Mawer's made on GCO, Global Credit, in 2024. And I think you'll know, as a credit person, I don't use the word ecstatic. It's a superlative. I don't use those very often to describe anything. Everything from putting the investment process in place to an on-time launch, to the take-up by investors that we've spoken to the interest by individuals and institutions in hearing the story and understanding the strategy. I would say everything to date has exceeded our expectations, and we had really high expectations. So AUM in the strategy is about 150 million. That's well ahead of where we thought we'd be. Plans for the future, with your help, Kevin, and many others, our goal is to continue to spread the good word. We believe GCO can function as either the entirety of an investor's fixed income solution or a portion of it, depending on the investor's risk tolerances and other things. And we expect to see AUM growth in kind of three areas: continued take up by individual clients. There is a move afoot for inclusion in balanced funds for the strategy. That's in the works. That'll take several months, but we're excited about that. And then we're laying a lot of groundwork with institutional clients who demand and expect a longer track record for the strategy, 3 to 5 years in many cases. But we're laying that groundwork now for future mandates. So we're excited about that. It's kind of day to day. A key tenet at Mawer, as you know, is not to sit still, keep learning, keep fine tuning. So we'll continue to work on the process, our risk scoring framework, collaboration with our equity colleagues, using technology smarter to help refine what it is we're looking at and examining. We're going to add selectively to the team. We're excited about that. All to the end that we believe we're building something really unique and special in terms of a credit business here at Mawer, and Mawer itself is a really unique and special place. So our objective is to build the world's best credit manager within the world's best investment management firm. So super excited about 2024 and extremely excited about the prospects for 2025 and beyond.
Awesome. Yes, definitely exciting. And thanks again for joining as always, Brian. Appreciate your time.
Thanks, Kevin. Good to talk to you.